Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, the regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining me this afternoon, we have Brian Stutland. He's managing partner at Equity Armor Investments, as well as Mike Khouw, CNBC contributor and chief strategist at OpenInterest.Pro. We're here to discuss what activity in the VIX and earnings suggest about markets ahead. It is great to have the both of you with us, as always, Brian, and really, that's the question that we're trying to answer. What's that catalyst? What's going to take us to the next level, to the up or downside? And of course, we want to see what the VIX perhaps is suggesting as we're going through this wait and see period.
Yeah, well, when you're talking about catalysts and the VIX, really it seems like anytime the word pops up, tariffs or some sort of tariff, Trump tariffs is going to hit, the market takes sort of a step back. We see volatility start to tick up. When you take a look at the VIX, just look at the charts there in terms of volatility, what traders expect upcoming for volatility for these markets. The VIX has continued to sort of make these higher lows, these successive higher lows in recent sort of days and couple weeks. And sort of today, we kind of have a little bit of a breakout. And I think what's even more interesting is when you look at VIX and the VIX futures, the VIX futures product is something that's trying to predict where the VIX will end up, let's say 30 or 60 days from now. Those futures are continuing to trade at a premium despite the VIX going up. What typically happens is you get a VIX spike, the VIX rises, the VIX futures start to mean revert and express a discount to where VIX has gone to volatility. But those futures now are expecting more volatility to come. And listen, we're entering a very volatile time of the year historically. March, one of the biggest rises in VIX month over month. So certainly traders are expecting some level of volatility to come back into this market as we've sort of hit all-time highs in both the Nasdaq and the S&P and trading right around there. We just haven't been able to get that catalyst to push through like you're asking.
Yeah, and Brian, that's something that looks completely different than what we discussed in January, where the VIX futures were showing a completely different picture, where it seemed as if it was a little bit more muted in terms of what traders were expecting with volatility back into the market. I think another area, Mike, that we have to talk about is the consumer, and Walmart earnings could be indicative of some pain ahead there as well, beating on the top and bottom line, however, taking a more cautious outlook. And I'm sure some of the uncertainty with the operating environment and tariffs lends to that.
Yeah, well, first of all, I think the tariff thing is kind of an interesting one because there's an element of the new administration's conversation about tariffs which is fair. So the idea of having some sort of tariff reciprocity has an element of fairness, although in many instances you're dealing with countries that do indeed charge tariffs of a form that are higher than what we charge on their products. So, for example, we charge 2.5% for cars coming in from Europe. If you go to the UK, they have a 10% import duty effectively. So that would be at a 7.5% increase if you were going to match that. The problem, and I think this is one of the things that you're seeing in the VIX futures curve that Brian was just alluding to, is that the way Trump discussed tariff reciprocity, he actually was also taking a look at things like VAT taxes, value-added taxes that they charge in Europe. And what's curious about that, of course, is that VAT taxes apply both to domestic products and imported products equally. So there is no essentially unfairness embedded in European VAT taxes. But if we tried to incorporate them, that would be kind of similar to if you can imagine Europeans saying, okay, well, we're going to factor in our import duties what you guys charge in sales taxes regionally in the United States, which would be very, very messy. It is inflationary, and it creates an unlevel playing field for products that are imported versus domestic ones. Now, whether people want that as a policy preference is a different issue, but I think that contributes materially to concerns about inflation, and it is what's baked into those VIX futures. Now, if you take a look at the consumer and you see what's happening with Walmart, Walmart's valuation was one that I had a really hard time getting my arms around even before their numbers came out, because what the street had been looking for was probably 5% top line growth. They obviously have a very good operating business. They were seeing something better than GDP growth on the top line. They have obviously brought groceries into the stores. That has helped essentially, get traffic in to look at other things. So you can imagine that a weaker consumer might not go shopping for goods, but if you have them in there for groceries, which they have to buy every week anyway, then presumably that's going to be a good thing. But what they're guiding to now is about 3 to 4% top line growth. 3 to 4% top line growth is effectively no growth in real terms if you factor in inflation. The CPI numbers were coming in around 3% or slightly higher. So I think, if you have a company that's not getting any real growth at the top line, why would you pay 35, 36 times forward earnings for that, which is where it's currently trading, even net of the 6.5%, 7% discount that you saw in the share price after they reported?
Mike, what did you also say, though? It could be part that, we're in the first quarter and having outlook for the full year. It's more challenging. It's further out. Do you think that plays into it as well, or it really is because of the fundamentals that we're seeing in the marketplace right now?
Well, I mean, we have a couple issues going on here. The first, from a fundamental standpoint, is that stocks aren't particularly cheap, and names like Walmart in particular really aren't cheap. It's hard to see why you would pay 35, 36 times forward for a company that's growing its top line less quickly than the S&P is on a weighted basis. So you figure that the S&P is probably getting 5, 6% top line growth on a weighted basis, and then you're getting effective adjusted EPS growth, at least over the last 5 to 10 years, of between 7 and 10%. So, why would you buy a Walmart at 35.5 times when you could get the S&P for 25 times and get better fundamentals and more diversification? Doesn't make any sense. As far as the consumers are concerned, we have our economy is 70% consumer driven.
Right.
And the most recent debt data that we got has, rising delinquencies, all-time records in terms of revolving debt. These things are really pressuring consumers. And there's an important reason why this is true. If you take a look at the inflation data and you go back to, say, January of 2021, and you take a look at the consumer price index is up about 21.5 or a little better than that in terms of percentage. So that's that's the adjusted price level for the products that consumers buy, right? So the net effect of inflation over a 4-year period. And if you take a look at the mean earnings, you will find that mean earnings are up about the same or slightly better, but median earnings are not. And what that means is median is half of the people are above that number, half of the people are below. What it means is that most Americans are not better off today on an inflation-adjusted basis than they were 4 years ago. Compare that to the 4 years preceding, where we had an increase in the CPI of about 7.5%, and we had an increase in median earnings of about 15.5%. So what that means is that in the 4 years before, people were 8% better off. Most people were better off. The most recent period, most people were not better off, and that's why you see these high levels of debt. And the fact is that if people don't have money, they can't spend it.
Right. Well, I mean, those are all valid points that you're making. I want to switch gears for a moment here with you and Brian and get into the AI and Mag 7 story. That's kind of seen a reversal as well. Most of the Mag 7, they're underperforming the broader market year to date. Why do you think that is? Has the story just stalled, or is it something more fundamental?
Yeah, I think when you're looking at these names here, it's very interesting. Obviously, we had news, and here's a chart just looking at the Mag 7 versus the S&P 500. When DeepSeek kind of came out and said, we're doing everything cheaper and better. All these names, this kind of tracks a Mag 7 ETF versus the S&P. We've seen those names lag. Year to date, the Mag 7 about unchanged on the year, with the S&P before today was up about 4%. So certainly that news and information. And then you had the earnings picture that came out on names from, Amazon to Google, to all these names, indicating such huge, massive spends to build out their LLMs, to build out their whole AI play, their data infrastructure. And the market, I think, has sort of gotten a little worried that all that spending is going to take a lot of time for the PEs and the growth and the level to sort of reach that spend. And it seems like there's somewhat of a pause on these big names. And obviously, these names are such a big part of the S&P. Is that some of the reason why we're seeing a sort of an increase in volatility, a sort of drag in the market, so to speak, because these names just can't be the leaders right now?
Right. And Mike, I want to talk about that CapEx spend for a moment here. Of course, the Mag 7 constituents of the Nasdaq 100, and we know that they are leaders when it comes to CapEx spend, and we've seen that translate into growth. I think part of the challenge now is this has to show a return on that investment into AI and being able to monetize this rather than just telling a story. What's next, I think, is what the marketplace is looking to hear.
Yeah, and I think we're probably going to get some lens on that when we start hearing from Jensen and the gang next week. I mean, that's obviously, if we think about CapEx in the AI space, NVIDIA is sort of the bellwether for everybody. My expectation is that this sort of DeepSeek news and things like that probably aren't going to have such a profound impact. If anything, I actually think it's motivating people to spend more and more quickly. Now that creates what we often discuss as that pigs in a python problem, where you have this one period of sort of, unusual or idiosyncratic growth, and then we sort of have to wait on the backside of that to see whether it actually ends up delivering results. I think it will. I have some, I'm one of these people that's pretty optimistic about the sort of schedule of technology developments and its increase on potential productivity, especially in the largest companies. I think there's a lot there. But I agree with you that it seems like investors, because what the question you ask is one I hear all the time. Investors tend to be very impatient, right? So even if the results are going to be profound 5 years out, if they don't start seeing them 5 months out, you could see share prices fall.
Yeah. And Brian, I think that's a great point that Mike makes with the lack of patience that's here. I mean, it would be naive to think that you're not going to see that same performance that we have over the past couple of years. I mean, these investments do take time to play out. It's not just as simple as buying the dip. I mean, these are core fundamentals within the corporate strategy.
Yeah, I mean, you will see these dips, and you will see, like, to Mike's point, these five, if you don't get results in 5 months, I'm selling now and I'll talk to you later. Well, I'm still really a believer in this entire build out. I think we're just sort of in the maybe first inning of this all. And there will be times, I mean, these are more volatile names. When you look at implied volatilities and the volatility levels on a day-to-day basis on any of the Mag 7, they trade at a higher level than the S&P. They trade in line with at least the Nasdaq 100, if not higher on some names like NVIDIA. And so there will be some levels of uncertainty and some levels of volatility that go along with it. And I think as an investor, does it mean just buy the dip right away and try and catch a falling knife? No, but there'll be some opportunities when things sort of get oversold and lead to opportunities to buy. And I would be looking to take advantage of that as things sort of trend along, because I think the future is real in these names. I think we're in the early innings of this, and I think there's still some opportunity to the upside. Who will be the absolute huge big winner? Who knows? But the Mag 7 all have a big foothold in this, and somebody's going to emerge from there. And I think buying some dips, waiting for like things to sort of settle in, might be some opportunities for investors to get in.
And Mike, let's finish on a positive note here with gold surge and the performance that it's seen not only in 2024, but since December 2025. It has had a pretty impressive run.
Yeah, it has. It's not just the price appreciation that sort of really caught my attention. Before we went live, your producer was asking some thoughtful questions about gold. And I think it's rather interesting, because we now have this conversation about whether Doge is going to actually get a peek inside of Fort Knox. I remember that it was, I think, Rand Paul who originally had asked whether he could have a look, which makes some sense. It is in Kentucky after all. He didn't actually end up getting a look, but some other people did. And they said, oh, it looks like the gold's all there. I don't know. But what is interesting in gold, so I was a former NYMEX guy. So NYMEX and COMEX were basically two different floors of One World Financial Center, and the metals all traded on the COMEX floor. When you think about the futures market, usually it's just used as a financial instrument, which is people use it to speculate or just to maintain exposure or to hedge, things like that. What has been unusual is the amount of physical delivery that people have been taking off of those futures contracts. And that to me does speak of some broader anxiety. It's unusual if you think about it this way. If you had full faith and credit in the credit of and the validity of financial instruments, what reason would there be to take physical delivery of gold? You have to store it, you have to insure it. It's easier just to trade and roll your futures. So I find that to be, people are not using this for industrial purposes. They're not making their own jewelry. It's basically, to me, just the fact that they're taking more physical delivery is indicative of a broader concern, that people are just more concerned. That is a safety trade, that you're not just wanting to be long the metal, but you actually want the physical metal. You want to, I don't know, stick it in your closet and under your bed. I don't know what you're going to do with it, but it doesn't speak to a great deal of confidence when people are taking additional physical delivery. And then we've also had that repatriation issue that preceded all of this. But, we had foreign governments that had gold in storage in the United States repatriating it. Again, that kind of speaks to, some separation in some cases between, the alliance effectively between the United States and Europe. But I think we saw some of that with the J.D. Vance security conference speech in Germany. that there is, some level of people being not very much at ease. And I think that's reflected in gold prices. And of course, we had hotter than expected CPI data. The PPI data was okay, but the CPI data came in a little hot, and I think that's a contributing factor too.
And Brian, to wrap up here, if you take a look at gold futures, or if you take a look at options on GLD as an example, what is that market signaling in terms of potential bullish or bearish action with the underlying?
Yeah, I mean, if you look at gold, obviously the chart sort of had like this double bottom breakout, and we've seen this kind of technical move in the past with gold where it does make this sort of double bottom formation and breaks to a higher high and then moves about 20% to the upside. That's happened a handful of times in the past over the last 20 years. More importantly, when you look at the options, though, I thought most interesting today, GLD, the calls outpacing put trading by 3-1. Typically, over the last 20 days, we've seen calls and puts. Calls normally outpace put buyers or put traders. In GLD, that's normally trades at about a 1.5 to 1 ratio of calls to puts. But the fact that calls are now trading 3-1 ratio to puts, to me, this is maybe some bullish indications that both GLD and gold, there is some level of fear, some concern that gold is going to move higher, and option traders are trying to play that. Or maybe they're just, hedging out, taking some profits, converting to calls or whatever after such a huge run up. But still, some bullish activity, at least in the options market.
All right. Appreciate both of your insights as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.